Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. Saying that the US stock market has averaged about 10% returns over the long run is an accurate statement. However, that doesn't mean that your portfolio is going to return an average of 10% over the coming decades. Where does this 10% figure come from? Why is everyone quote 10%? This 10% figure usually comes from people quoting the S&P 500 and the average returns that it has had over its entire history. And I think that it's more accurate to actually look at rolling returns of the S&P 500, not actually the entire history of the S&P 500, meaning that we're looking at it at certain time periods. So it might start in 1950 and then 10 years from that to 1960, or 1951 and 10 years from that would be 1961, and so on and so on. Those are 10-year rolling periods. I like to look at longer periods, so usually I'll look at 30-year rolling periods. Even if you do look at, let's say, 30-year rolling periods, you will see much different results than 10%. You can look at the lowest 30-year rolling returns, you can look at the highest 30-year rolling returns, and then also you can look at the average. What's the usual 30-year rolling returns? Now, I have several reasons for you on why your portfolio probably won't make 10%. It probably won't mimic, 30-year rolling returns for the S&P 500. And I'm going to give you several reasons for that. But I also want to say really quick that I made this video because I actually watched another video from the Money Guy show where they answered a similar question to that, where they went over a topic that was similar to these, like how do you get these 10% returns? But I'll talk more about their video at the end of this video. Let's get on to why I think that you're not going to make that 10% return, why your portfolio is not going to be like the S&P 500. And first off, it's probably because you might have a more diversified portfolio. Your entire investment portfolio might not be just the S&P 500. Now, there are many people that do only invest in the S&P 500, and I'm not saying that that's wrong. I'm not saying that's a bad portfolio or anything. That's been a very successful portfolio up to this point. You might have some international stock holdings within your portfolio. I currently have about 20% of my stock investments in an international stock market index fund. You might also maybe possibly have REITs or real estate investment trusts in your portfolio. You're investing in companies that invest in real estate. You might have bonds in your portfolio. This is probably one of the most common ways people diversify away from stocks, and that is bonds. So you might have, 10%, 20%, 30%, 40%, or like super conservative 50% or more of your investments in bonds. And that's certainly going to change what your long-term ROI is going to be. Additionally, you might be investing in individual stocks. Many people who are really into investing, even if they have a majority of their investments in index funds, they invest sometimes in individual stocks, maybe with some, extra play money, they like to call it, or maybe just with 10% of their portfolio, they like to pick and choose individual stocks. Some investors invest in mutual funds that are not index funds, that don't just match the market returns. Some invest in actively managed mutual funds. The point is, if your portfolio isn't only comprised of the S&P 500, then your portfolio returns are going to most likely differ from what the S&P 500 returns over any rolling period. So if the S&P 500 returned, that 10%, that magic 10% everyone likes to quote, if it returned that over the next 30 years, your portfolio might return more or less than that because of what you have diversified in your portfolio. But portfolio diversification is not the only reason why you might not get those 10% average annual returns. Another reason why you might not get those returns is because you haven't liked this video already. No, seriously though, if you're enjoying this video so far, please make sure you like the video. It really does help me out and I would really appreciate that. Liking this video is going to allow you to receive much larger returns than the stock market averages. Okay, maybe not, but I still would really appreciate it. Now, moving on to my next point, I already mentioned that bonds can diversify your portfolio, so your portfolio might be more diversified, but I also want to expand more on bonds in your portfolio. Bonds are lending money to companies and or governments, while stocks are ownership in a company. Bonds are typically going to be a lot less volatile than stocks. It doesn't mean they have no volatility. They can change due to the federal interest rate and maybe among other things as well. Overall, bonds are typically going to return less than stocks are over the long run especially, and they're probably going to have a lot less fluctuations or volatility than stocks are in the long run. By having bonds in your portfolio, usually you are going to be exchanging some volatility in place of lower returns. You're going to say, hey, I want less volatility in my portfolio and I'm willing to accept slightly lower returns. Even a relatively small amount of bonds in your portfolio, let's say 20%, it's been shown to reduce your volatility of your overall portfolio to a greater degree than you have actually sacrificed in total return. That's why a lot of advisors advise people to invest some of their investments in bonds. That's generally going to be pretty good advice. However, do keep in mind that that means that your portfolio is probably going to return less, if that is the case, than what the rolling 30-year returns are for the S&P 500. And next, I have another really good reason on why your portfolio probably won't return 10%. And this is probably the biggest reason that applies to most people. But before I move on to that, I just want to know from you in the comments below. When you estimate what returns you're going to get when you're looking over long periods of time, let's say for the next 30 years, what is the estimate that you use for your portfolio? I'm really curious to know. Typically, what I'll use is I'll just revert to around 8%. I think that's a pretty fair number to use, especially since my portfolio is 100% stocks. Of course, no one knows what the future is going to hold, but I want to know from you in the comments below what you use to estimate your future projections for your portfolio. But getting back to my next reason on why your portfolio probably won't match the S&P 500 is that investors have crazy behaviors. Investor behavior is a phenomenon where you sometimes don't act rationally, or maybe you do act rationally, but that is counter to what you probably should be doing. So most investors, even if they invest in the S&P 500, even if they invest in a broad total stock market and they're trying to match those returns, they might not even get those returns simply because they are letting their behavior and their emotions take control, and they're exiting the market when things are bad, and they're not re-entering the market until things are good again. So they are literally selling low and buying high. And that can lead you to having much lower returns in the long run if you let this kind of bad investor behavior take a hold of you. Because when we're talking about that 10% rolling returns, usually what that entails is you having a lump sum investment at year one, and then over the course of that lump sum investment is left alone. And then over the years, you're going to receive dividends on that lump sum investment, and those dividends are automatically reinvested into that amount. So if you started with $10,000, you say, hey, I'm investing $10,000 on day one, I'm leaving it in there, and then all the dividends from the S&P 500 are going to get reinvested into that $10,000, and it's just going to grow for 30 years. That's usually how these things are calculated when we're talking about rolling 30-year returns. But this does usually not mimic what investor behavior is, because a lot of investors, they might take their dividends out. They might use it for something else rather than reinvesting it back into the same fund. Maybe they panic when the market drops 30% in March of 2020 and they sell off their investments. They think this is the end of the world. And so they sold off their investments. They lost 30% on what it previously was. And then the market recovers a month later and they're like, oh man, that is the point here, that many investors are not going to have the same returns that the S&P 500 is going to show. And the funny thing about this, you might have heard of this. Apparently there was a study done by Fidelity where they said who are the best investors or who make the best returns. And it turned out, I don't know if this is true, but apparently it turned out that the best investors were people who forgot they had an account at Fidelity, or people who had already passed away, who are already dead. So they were the best investors because they didn't actually mess with their investments. Now, I'm not 100% sure if that is actually true, but it does illustrate a point that sometimes the best way to invest is to just leave it alone and let it do its thing. Let compound interest do its thing. Let the market grow, let your investments grow, and do not bother them. Now, as I mentioned previously, the reason why I made this video was I was actually inspired by another video I watched by the Money Guy Show, where they talked about how to find this magical 10% average returns over the long run. How do you find some investment that's going to do that? And so I wanted to touch on this when it comes to how your portfolio is probably going to perform and relatively to what people usually quote, which is the S&P 500. If you're interested in watching their video, I'm going to put it in the link in the description below, in the pinned comment below, and it's also going to pop up on the screen after I get off the screen. Thank you so much for watching this video. I'm Zach from uncashflow.com, and I hope to see you next time.